Hi, Michael Glennon from Glennon Capital. Today I'm going to talk to you about a topic that's at the forefront of many investors' minds, and that's dividends, and especially fully franked dividends, which is where a company pays tax, and that tax can be offset as a franking credit for retail investors. And they become very attractive because of the tax system in Australia and self-managed super funds, in that they're taxed at a lower rate than the company tax rate. So those self-managed super funds actually get a higher yield on an after-tax basis than an individual investor would get. So, Australian investors, constant demand for dividend, but what it does is it creates a problem for many companies, and especially where we operate in the market, the small cap sector and growing small companies. So the management of a company has this constant dilemma about, if they're growing, about capital and how to allocate capital. So do they retain the earnings that they've made from profits and use that to grow, or do they pay that money out to investors? And so it's a constant challenge. Something that we're faced with every day when we're looking at companies is, does the management have the confidence to be able to pay out a dividend without impacting their future growth? Or do the company think it's more important to actually pay a dividend to shareholders, keep shareholders happy, yet dilute shareholders slightly by raising capital further down the track when they need that capital to keep growing? So something we always say to management, important to have a stream of dividends flowing back to investors, but investors also need to be cognizant of the fact that the more a company pays out, the less that they can grow. So there is a trade-off. High growth companies struggling for cash quite often, the more they pay out, the harder it is for them to grow. Yet lower growth companies with strong cash flow, investors will get high dividend yield but less growth. So important consideration, something that comes up every day. And in general, small caps do have a lower dividend yield than large caps. It's worth also highlighting that this situation is unique in Australia. It's not the same in the US. That's why great investors like Warren Buffett and Berkshire Hathaway don't pay dividends to their investors. We don't have that situation here. So very difficult decision for management to make. It's something that we look at in terms of companies, but our sole driver is not the dividend income. It's really about getting capital appreciation in the shares, because we think that capital appreciation and getting high returns on equity and the assets that are employed in the business is key to having good investment returns in our portfolio over the long run. So something to be aware of. It's not all about the dividend, it's really about getting capital growth and income out of those investments. So something to be aware of, something that you should look at when you're investing, and I hope that shed some more light on the topic and the dilemma that's faced by small company management. I'm Michael Glennon, and thank you for watching.